move that could reshape the global commodities landscape, the Shanghai Futures Exchange has announced sweeping reforms that will allow direct participation from overseas investors in China's domestic gold and silver futures markets. For the first time, foreign brokers could trade on the exchange without the need for an onshore intermediary. Margin requirements would be accepted in foreign currencies, and physical delivery would be a core feature of these contracts. This isn't just a bureaucratic update, it's, as one person put it, a constitutional change. Beijing is making a clear bid to shift global pricing power eastward, reflecting its dominant position in physical metals production and consumption. If the reforms pass and Shanghai becomes the centre of physically settled metals trading, it will mark the beginning of the end for paper gold markets controlled by Western institutions. For decades, reference prices have been dictated in London and New York. Now, China wants real gold, not leverage contracts, to set the standard. And this is just one piece of a far larger puzzle. If China truly wanted to undermine the US dollar's dominance, how would it go about it? Well, it wouldn't announce its intentions with fireworks. There would be no dramatic dumping of treasuries, no flashy currency announcements, or overt declarations of war on the dollar. That's not how Beijing operates. Instead, the move would be slow, deliberate, strategic. It would unfold quietly behind closed doors in policy documents, trade settlements, and crucially, in vaults filled with gold. What China is doing now is nothing short of a silent re-engineering of the global financial order. And at the heart of this transformation lies a simple but powerful pairing: gold and yuan. China's relationship with the US dollar has always been a double-edged sword. For years, Beijing amassed a vast portfolio of US Treasuries peaking over 1.3 trillion. This was a byproduct of its trade surplus and the structure of global finance. But in recent years, China has started trimming its exposure, reducing its holdings to around $759 billion. On the surface, this appears to be standard portfolio rebalancing, but in reality, it is part of a much larger strategy. Holding too many dollar-denominated assets leaves China vulnerable to the whims of Washington. The risk is not merely theoretical. China has watched as the US has used the dollar-based system to impose sanctions, freeze assets, and apply pressure on geopolitical rivals. And with each incident, the message becomes clearer. The dollar can and will be used as a weapon. And so China is acting accordingly. Rather than risk exposure to an unpredictable political environment, Beijing is shifting its reserves towards assets that are, by their very nature, politically neutral. Chief among those is gold. And officially, China holds just over 2,290 tons, making up around 6.5% of its official reserves. But many analysts believe the true figure is far higher. And some suggest that the People's Bank of China may be buying gold at multiples of the rate it discloses, bringing its real holdings closer to 25,000 tons or more, not to mention how much the public privately own. Now, gold offers Beijing more than just security. It offers sovereignty. It cannot be sanctioned, frozen, or devalued by foreign central banks. It is, in essence, the opposite of the dollar. And this is where the strategy gets even more interesting, because it's not just about stockpiling gold and reducing exposure to US debt. It's also about building an alternative financial system, one that is capable of functioning independently from the dollar and, over time, replacing it altogether. Part of this effort involves the gradual internationalization of the yuan. And now, historically, the Chinese currency has been constrained by strict capital controls and a lack of global trust. But rather than liberalize the yuan too quickly, which could invite instability, China is taking a slower, more calculated path. It is tying the yuan to gold. Through initiatives like the Shanghai Gold Exchange and the Shanghai Futures Exchange, China is offering a market where gold is not just a speculative asset, but a key part of the financial system. And crucially, it is creating mechanisms for physical settlement, not just paper speculation. China's proposed reforms to the Shanghai Futures Exchange would open its gold futures market to foreign participants. But unlike the paper-based trading of the COMEX or that we see the LBMA, these contracts are tied to physical delivery. If approved, This change would be a profound shift in the way gold is priced and traded. It would mean that actual possession of gold, not just leverage bets on its future price, would start to determine market value. Now, this might sound like a minor procedural change, but in reality, it's a direct challenge to the Western dominated pricing system that has existed since the 19th century. If Shanghai becomes the global hub for physical gold settlement, then China sets the price. And once physical demand starts dictating the price of gold, not ETF flows or speculative futures trade, well, then the power dynamic in global finance begins to tilt. There is something elegant about China's approach. It doesn't seek to trigger a crisis or escalate tensions. Beijing has no desire to blow up the system. Instead, it is quietly opting out of it, building a parallel framework that functions on different principles. Gold plays a crucial symbolic role in this effort. Unlike fiat currencies, which rely on faith in government and central bank policy, gold is grounded in something more enduring. It carries no counterparty risk. Its value is recognized across cultures and centuries. For countries wary of the dollar's dominance, this matters, especially when that dominance is increasingly viewed not as a service, but as a form of control. And this is where China's strategy starts to find willing participants. Countries like Russia, Iran, Venezuela, and others who have found themselves at the sharp end of the Western financial system are increasingly turning to yuan-based trade and gold settlement. Not because they trust Beijing unconditionally, but because they are desperate for alternatives. Even among non-sanctioned nations, there is a growing discomfort with the fragility of the current system. The United States is running record deficits. Its debt is ballooning. Its financial institutions are buckling under the weight of low-yield assets bought during the pandemic. Bank of America, for example, holds over $700 billion in bonds purchased when yields were near 1%. Those bonds are now down around 40%, hiding losses which are well over the much-quoted $100 billion. And meanwhile, the Treasury is trying to refinance $9 trillion and raise an additional $2.5 trillion in new debt this year. But with foreign buyers increasingly reluctant to step in, the only solution may be for the Fed to restart large-scale bond buying. And that, of course, would further undermine confidence in the dollar and send inflation expectations surging. If yields rise to 7 or 10%, some major US banks may not survive the fallout. It doesn't take much imagination to see how that story ends. Frozen ATMs, bank runs, and a public waking up to the risks of a fractional reserve system that was always one crisis away from collapse. In that context, gold starts to look less like a luxury and more like a lifeline. There is frequent speculation that China may launch a gold-backed digital yuan. In truth, a fully gold-backed currency is unlikely in the near term. The demands of modern trade volumes make it difficult to anchor a currency entirely to a physical commodity. But that doesn't mean that gold won't play a significant role. A partially gold-backed or gold-supported yuan could offer something far more potent: credibility. In an age of fear excess and monetary manipulation, even a modest link to gold signals discipline, prudence, and long-term vision. And that might be enough. It is certainly enough for many countries in the global south. As central bank digital currencies develop and alternative clearing systems emerge, the yuan, supported by real assets and underpinned by a growing physical gold infrastructure, becomes an increasingly attractive option. China does not need to convince the whole world to switch overnight. It just needs a critical mass of countries and institutions willing to hedge. And as that hedge becomes more mainstream, the old order starts to crack. What China is building is not a revolution, it's a reset. By accumulating gold and gradually elevating the yuan in global trade, Beijing is creating a form of monetary leverage that doesn't provoke confrontation, but still weakens the dollar's monopoly. It's not doing this for show, it's doing it because it knows the current system is unsustainable. Gold in this strategy is more than just a store of value. It is a tool of diplomacy, a stabilizer, a silent vote of no confidence in Western monetary policy. And when paired with a currency like the yuan, controlled, state-backed, and increasingly trusted, it becomes part of a new architecture, one that seeks resilience rather than dominance. Now, the dollar won't disappear tomorrow, but its role is being questioned in ways that were unthinkable just a decade ago. And at the center of that shift is China, not just participating in the global financial system, but quietly rewriting its rules. And if you want to get ready for the new financial system, then why don't you head for the exit? Click on the link below, get your exit plan now.